Let's start with a fantasy. You take $1,000, buy a stock trading for just a few cents, and in a few months, it rockets to $10. That $1,000 is now $100,000. It's a life-changing return, and it's this exact fantasy that fuels the entire world of penny stocks. But here's the cold, hard reality. For every one person who might see that kind of gain, there are thousands, maybe tens of thousands, who lose their entire investment. The world of penny stocks isn't a gold rush, it's a minefield, designed to look like a gold rush to separate optimistic beginners from their money. So, what exactly are these controversial investments, and is there any scenario where they are actually worth the colossal risk? That's what we're going to unpack today, with clear eyes and no hype. We're going to move beyond the get-rich-quick YouTube ads and the anonymous forum posts screaming about the next big thing. This isn't about scaring you away, it's about arming you with the truth. We'll break this down into 3 critical parts. First, we'll define what penny stocks really are, beyond just the price, and where you even find them. Second, we'll expose the 4 massive risks that make them so dangerous for retail investors. And third, we'll talk about the one and only responsible way to even think about speculating in this space, if you're absolutely determined to do so. My goal by the end of this video is not to tell you what to do, but to ensure that if you ever decide to put a single dollar into a penny stock, you do so with your eyes wide open to the very real dangers. So, what exactly is a penny stock? Most people think it's any stock trading under $1, and while that's often true, the official definition is a bit broader. Traditionally, the SEC defined a penny stock as any security trading under $5 per share. However, the modern understanding, especially in the wake of the GameStop frenzy, includes any low-priced, highly speculative stock, often with a small market capitalization, or microcap. These are not the blue-chip companies like Apple or Microsoft that you find on the major exchanges. The vast majority of penny stocks trade over-the-counter, or OTC. You can see these on platforms like Robinhood or Fidelity by looking for stocks with a PK or OB suffix. OTC markets are a wild west compared to the New York Stock Exchange or the Nasdaq. The listing requirements are incredibly lax. A company on the Nasdaq has to maintain a minimum stock price, a certain number of shareholders, and meet strict financial reporting standards. An OTC company has to do almost none of that. This leads to our first major point: information asymmetry. When you're researching a company like Coca-Cola, you have decades of audited financial statements, analyst reports from major banks, and intense media scrutiny. When you're researching a typical penny stock, you might find a bare-bones website, press releases that are pure hype, and no independent analysis. You are fundamentally at an information disadvantage. The company insiders and the large, early investors know everything, and you, the retail trader, are working with the crumbs they choose to drop. This setup is the perfect breeding ground for the single biggest danger in the penny stock world, the pump and dump scheme. Let's talk about how a pump and dump actually works, because understanding this mechanism is your best defense. It's a simple, ruthless process. First, a group of coordinated traders, or sometimes the company insiders themselves, accumulate a massive position in a dirt-cheap stock, often one that is barely operational. This is the accumulation phase. Then begins the pump. They will use every tool at their disposal to create a frenzy of buying. This means blasting out millions of spam emails with outrageous subject lines like stock pick of the century. It means paying promoters to make slick YouTube videos talking about the company's groundbreaking technology. It means flooding social media platforms like Twitter and Reddit with bots and paid shills, all posting rocket ship emojis and talking about imminent takeoffs. They create a powerful illusion of demand and a fear of missing out, or FOMO. As unsuspecting retail investors see this buzz and start buying, the price begins to artificially inflate. The chart starts to look parabolic, which attracts even more momentum traders who don't even know what the company does. This is the trap. Then, once the price has been pumped to a sufficiently high level, the orchestrators execute the dump. They sell their entire massive holdings all at once. This sudden, enormous wave of selling crashes the price instantly. The retail investors who bought in during the hype are left holding the bag, watching their investment evaporate in minutes or hours. The promoters go quiet, and they move on to the next stock. Pro tip: one of the biggest red flags is an anonymous source on the internet telling you about a sure thing in a tiny, unknown company. If it were such a sure thing, why would they be sharing it with millions of strangers? They're not being charitable. They are creating the exit liquidity for their own profit. Beyond intentional manipulation, penny stocks carry other enormous risks. They are incredibly illiquid. This means there are very few buyers and sellers. You might see a stock price quoted at 10 cents, but when you try to sell $10,000 worth of it, you could crash the price down to 5 cents just by entering your sell order because there's simply no one on the other side to buy it. This low liquidity also makes them incredibly volatile. A stock can move 50% in a day on virtually no news, making it impossible to manage risk with standard stop-loss orders. Given all these terrifying risks, is there any scenario where penny stocks could be worth it? The answer for 99% of investors is a resounding no. They are a speculative gamble, not an investment. Your capital is almost always better off in a diversified portfolio of ETFs or in thoroughly researched, established companies. However, if you are still determined to allocate a tiny, speculative portion of your portfolio money you are fully prepared to lose completely, like the cost of a night out at a casino, then you must adopt a ruthless, disciplined approach. First, and this is non-negotiable, you must do deeper due diligence than you would for any other investment. This means going beyond the hype and reading the company's actual SEC filings, if they even file them. Look for real revenue, real customers, and a manageable amount of debt. Be deeply skeptical of any company whose primary business seems to be issuing press releases. Second, you must use strict position sizing. No single penny stock trade should ever represent more than 1 to 2% of your total trading capital. If you have a $10,000 account, that means your maximum risk on one of these trades is $1 or $200. This ensures that even a total loss on a trade is a manageable setback, not an account-ending disaster. Third, you must have a clear exit strategy before you even enter the trade. Decide beforehand at what price you will take profits and at what price you will cut your losses, and stick to it. The emotional pull of these stocks is immense. You'll want to hold on for more gains when it's going up, and you'll want to hold and hope when it's crashing, praying it will come back. This is how small losses turn into total wipeouts. The only way to win in this environment is to be a disciplined contrarian, buying when there is no hype and selling into the mania that others create. But I must be blunt, this is an incredibly difficult game, and the odds are stacked heavily against you. Before we finish, I need to be unequivocally clear with a critical disclaimer. Trading penny stocks is one of the riskiest financial activities a retail investor can undertake. The potential for a 100% loss of your invested capital is extremely high. The market for these securities is plagued by manipulation, fraud, and a lack of transparency. I am not a licensed financial advisor, and this video is solely for educational and informational purposes. This is not a recommendation to buy or sell any security. You should only risk capital that you are absolutely prepared to lose entirely, and you should always consult with a qualified financial professional before making any investment decisions. Past performance, especially in the penny stock space, is absolutely not indicative of future results. Your call to action today is a simple one. If you're tempted by the siren song of penny stocks, I want you to open a paper trading account on a platform like Thinkorswim or TradingView. Allocate a fictional $10,000 and try trading these volatile stocks for a month with fake money. Track your results with ruthless honesty. I can almost guarantee this virtual experience will be far more educational and far cheaper than learning the same lessons with your real hard-earned cash. If this no-nonsense guide helped you understand the true nature of penny stocks, please hit that like button and subscribe for more content that prioritizes your financial safety and education. Thanks for watching.